Last week, the Nasdaq surged. Chip stocks came roaring back. Investors celebrated the recovery from a trillion-dollar sell-off, and almost every headline focused on the same names: Nvidia, Micron, the US semiconductor rebound. But while that story dominated the screen, something else happened. Something that got far less attention. And it may be the more important financial development of the week. China's AI sector just crossed a line, not a symbolic one, a commercial one. And that difference matters more than most investors currently understand. Here's what actually happened. Tencent Holdings is now testing an embedded AI agent inside WeChat. WeChat is not just a messaging app. It is China's most powerful digital ecosystem. Over 1 billion people use it daily for messaging, payments, shopping, healthcare, and government services. It is the closest thing to an all-in-one financial and social operating system that exists anywhere on Earth. Now Tencent wants to embed an AI agent directly inside that platform. According to the Financial Times, the regulatory approval process could begin as early as this month. Tencent's Hong Kong-listed shares rose on that news. But the market reaction may have actually understated what this represents, because there is a phrase that serious investors should be paying close attention to right now: the shift from model development to commercial deployment. For the last 2 years, the AI story has been largely about building models, building chips, building infrastructure, training enormous systems at enormous cost. That phase created the Nvidia supercycle. It created the data center boom. It drove hundreds of billions of dollars into AI-adjacent stocks. But here is where the story starts to change. When AI moves from development into deployment, the economic model flips. Suddenly, it is not about who spends the most. It is about who reaches users at scale first. That is a completely different race. And Tencent, sitting on top of over 1 billion active WeChat users, is lining up at the starting line with an extraordinary head start. Think about what embedded AI inside WeChat actually means practically. Imagine having an AI assistant that knows your payment history, that understands your social connections, that can book a doctor, transfer money, order food, and answer complex questions, all inside one app, all without switching platforms. That is not a feature update. That is a fundamental shift in how hundreds of millions of people will interact with technology every single day. And the company sitting at the center of that shift just had its shares rise on the news. Now hold that thought for a moment, because there is a second story from China this week that adds another layer. DeepSeek, China's most talked about AI startup, is reportedly exploring a fundraising round. The reported valuation? Roughly $52 billion. Neither DeepSeek nor prospective investors have publicly confirmed the plans. But the fact that this number is being discussed at all tells you something important. It tells you that private investors believe China's AI sector is entering a serious commercial monetization phase. A $52 billion valuation is not a research project. That is a business. A business investors believe can generate returns at scale. And this is the part that should make everyday investors stop and think. If you currently hold a broad global ETF or an S&P 500 index fund, your AI exposure is heavily concentrated in US names. That is not wrong. US tech has delivered extraordinary returns, but it does mean you are watching one side of a two-sided race. China's AI sector is not a mirror image of the US version. It operates differently, it has different regulatory dynamics, different monetization paths, and crucially, it has distribution advantages that Western AI companies cannot replicate. No American AI company has a platform with WeChat's combination of social, financial, and commercial reach. That is a structural advantage, not a political talking point, a financial reality. If you are finding this useful, consider subscribing for more practical financial insights. Now let us be honest about the risks here, because this is not a one-sided story. China's equity markets had a difficult week. The CSI 300 index fell 1.54%. The Shanghai Composite dropped 1.00%. Hong Kong's Hang Seng fell 0.88%. So the same week that Tencent's AI news generated excitement, broader Chinese equities were under pressure. That tension is real. Investors were weighing uneven economic recovery data. May PMI surveys pointed to a patchy domestic economy. Currency pressure and policy uncertainty hit other Asian markets. Indonesia, for example, was one of the worst performing markets in Asia this week. Investors are not operating with a simple China bullish narrative. They are navigating complexity, and that complexity is actually where the interesting opportunity tends to hide. Because when markets are messy, and sentiment is uneven, and headlines are mixed, That is precisely when long-term financial insight separates patient investors from reactive ones. Here's a practical way to think about this. Most everyday investors have two possible errors when it comes to China's AI story right now. The first error is complete avoidance, assuming the geopolitical noise makes China uninvestable, walking away from a market that is home to some of the world's most sophisticated technology companies, missing the deployment phase entirely. The second error is uncritical enthusiasm, assuming China's AI surge is automatic, ignoring regulatory risk, currency risk, and the real earnings uncertainty that comes with any early-stage commercial rollout. The investors who will navigate this well are the ones who do neither. They are the ones asking better questions. Not is China investable or not, but which specific companies have genuine deployment advantages? Which platforms already have the user base to monetize AI at scale? Which valuations already reflect the hype versus which ones still reflect genuine uncertainty? Tencent is a company with real cash generation, real user data, and now a potential AI agent embedded inside the most powerful consumer platform in the world's second largest economy. DeepSeek is a startup being valued at $52 billion by sophisticated investors who presumably understand the risks better than most retail headlines suggest. These are not vague stories. They are specific, financially consequential developments, and they are happening right now. The broader market context this week amplified all of this. Nasdaq surged as chip stocks recovered from what some analysts called a trillion-dollar wipeout. Oil prices spiked, then eased after Iran announced it was halting military strikes against Israel. Treasury yields are elevated. The Federal Reserve's rate path remains uncertain. Global markets are navigating a genuinely complex environment. In that environment, diversification is not just a textbook concept. It is a live financial strategy, and the investor is currently thinking only about U.S. tech or only about the domestic market are carrying a concentration risk they may not fully see yet. China's AI commercial deployment phase is not guaranteed to succeed, but it is guaranteed to be financially significant either way. Understanding it is not optional for serious global investors anymore. The market is moving fast. The people paying attention to the full picture right now will thank themselves later.